Everybody's chasing the next big blockchain breakout. But what if the real edge isn't speed or technology? It's just knowing where to look before the crowd shows up. We're talking layer 1 and layer 2 networks, billions of dollars in liquidity shifting overnight, and developers quietly building what retail investors won't discover until the price is already up 300%. Let's back up. Because if you don't understand what a layer 1 or layer 2 actually is, you're already playing the game blindfolded. Think of a layer 1 like a highway, Ethereum, Solana, Avalanche, and a layer 2 like a carpool lane built on top of it to move faster and cheaper, like Arbitrum or Optimism. Back in 2021, everyone was screaming that Solana was the Ethereum killer. And for a hot minute, the charts agreed with them. Then network outages hit, sentiment cracked, and suddenly the killer needed life support. Funny how that works. The psychological whiplash in this space is real, because 1 month you're reading Forbes headlines about a new chain revolutionizing finance, and the next month the Discord is a ghost town. Veteran investors like Raoul Pal have pointed out that conviction in crypto is often just recency bias, wearing a white paper as a costume. History shows us that every major crypto cycle has a "it's different this time" narrative, and every single time, the cycle still rhymes, it just wears a different outfit. Whether it was EOS in 2018 or Terra Luna in 2022, the hype arc follows a pattern so predictable, it's almost boring to watch. Here's the dirty secret though. The breakout almost never comes from the loudest project in the room. It comes from the one with growing developer activity, rising total value locked, and an expanding user base metrics that most retail investors never even glance at. A common misconception is that you need to find the best technology to win. But crypto markets don't reward being right, they reward being early. Fundamentals matter eventually, but in the short term, narrative and momentum are the actual market-moving forces you need to track. So what's the practical playbook here? Watch GitHub, commit activity, monitor on-chain data through tools like DeFi Llama or Nansen, and pay attention to where venture capital is quietly deploying, because smart money almost always moves before the tweet storms do. Position sizing is everything in a space where a network can gain 500% or lose 90% in the same calendar year. You're not trying to bet the house, you're trying to stay in the game long enough for compounding and timing to do the heavy lifting. The investors who actually build wealth in layer 1 and layer 2 cycles aren't the ones with the hottest takes on crypto Twitter. They're the ones who sized responsibly, kept dry powder, and didn't panic sell during the inevitable 30 to 50% drawdowns. Process beats prediction almost every single time. There's something almost philosophical about this whole space. It forces you to get comfortable with uncertainty in a way most asset classes never demand. The market will humble you, and that humbling, if you let it, actually makes you a sharper, more disciplined investor. And honestly, whether the next breakout is a zero-knowledge roll-up, a modular blockchain, or something that doesn't even have a name yet, the framework for finding it stays the same. Build your process, watch the signals, size your positions with respect, and let the crowd show up fashionably late while you're already positioned. The edge in this game was never a secret alpha call whispered in a Telegram group. It was always discipline, patience, and a willingness to do the boring work that most people skip. And if you're ready to start applying that same disciplined, research-driven mindset to building real-world wealth, check out our links in the description below where we can help you get started in real estate investing, home contracting work, and finding lenders.